Part of it is also understanding the terms. The purchase price is the big thing everyone always focuses on. And it certainly is the most important thing. But there are other things that are just as important. You want to understand the terms. So, how long do you need to close? Are you using hard money? Are you using agency debt? Are you using all cash offer? So, I think the cash that you're using or the money you're using is an important thing. What contingencies do you have at play? Are you willing to waive those contingencies? Are you willing to shorten the time frame for those contingencies to be applied? Will you go hard? Hard money, works really well.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
John, first things first, welcome back to the show.
Sam, thank you for having me back. I mean, listen, being episode number 2, that's an honor. I got to ask, who's number 1 now?
It's a buddy of mine here in Memphis.
All right.
And
All
I,
right.
I apologize, but yeah, it was a buddy of mine here in Memphis, and you got episode number 2. Hey, the honor was mine, man. Starting out a podcast, it's tough. People don't probably think about that. It's tough out of the gate to go, gosh, why does anyone want to talk to me, right? But now when this goes live, I don't know where it'll be, 340 or 350 or so episodes in. So it was fun. Thanks for making a gamble on the beginning and then coming back again here today.
I'm glad you stuck with it.
Absolutely. So am I, man. It's been one of the best things I've done. So, I really want to dig into your last 12 months. I mean, we have, last time we spoke was, almost a year ago. 2021's been a wild ride for everybody. Can you kind of just walk us through what the year has been for you guys? What lessons you've learned? I mean, the floor is yours. Just kick it off and tell us about the last year.
Well, I mean, I think, when COVID first hit, everyone kind of hit the pause button, right? Try to figure out what in the world's going on, what's going to happen, how will people react? And what we found is, overall, the market has done pretty well. Obviously, some of that is driven by some of the government regulations and the stipends and things like that have been put in place. But if you look at the multifamily industry, it's performed extremely well. And when you look at kind of the current state of things, we've got inflation on the rise. We have low demand for properties. We've got a global crisis still playing out. Well, apartments are a really good bet. Why? They're US-based assets. So people from around the world are looking to park their capital in places where it feels secure. You got to keep in mind that in some of these countries, there's different corruption and different elements that come into play where you may not want to keep your money sitting in the bank. So people like to have money in US-backed real estate assets. So you have investors from Australia and France and Canada and all over the world who are looking to invest in US real estate. Keep in mind that US real estate, in particular multifamily, has the trifecta of providing cash flow, appreciation, and tax benefits. So there's a lot of demand for these properties. So I set that up to say, we took the back half of 2020 to kind of assess what was going on and what we wanted to do going forward and just kind of see how things played out. We didn't acquire anything in 2020. It was the first year in the last 5 years that we didn't buy an asset. Wow. So we kind of waited to see what was going to take place. We had some deals in motion, paused some things, delayed some other things, but ultimately we got back onto it towards the back half of the year. And then coming in 2021, we've hit the ground running a little bit more. So we closed on an 81 unit property in Florence, Kentucky. We've got a 104 unit property in Louisville, Kentucky. By the time this comes out, that property will be closed. And, we're continuing to grow, continue to look for new opportunities. But I mean, those 2 deals were about $20 million worth of real estate, which for us, it's still a pretty good size. We've been a general partner on a lot of deals where we've been kind of the B-roll, right, in the passenger seat or the back seat of the car. But we've been in the driver's side now. So being in the driver's side a little bit more. We've done some JV deals where we drove those deals. So we're really understanding where we want to go going forward. And for us, it comes down to 2 different ways of doing business. One is these deals where we are in the driver's seat, right? We're leading the deals. We have a partner that likes to lead the asset management side and work with the property managers. We kind of take the lead on the investor relations side, the business plan, making sure that the marketing strategy is all tight. We know what we're doing. We know why we're doing it. We understand everything that we're going to do from the implementation. And we just kind of partner with our folks to make sure that vision is executed. On the flip side, we do like being a general partner where we can get exposure to different markets. I'm in the Midwest, I'm in Cincinnati, and I love Indianapolis, Columbus, Louisville, Florence, Kentucky. I love these markets, but we know what's happening around the country, right? There's great opportunities, great population growth in Florida, Texas, Georgia, the Carolinas. And we really want to make sure we can provide that exposure to our investors as well. So we do still like to partner with other operators who are doing deals and finding opportunities in those markets. So that's where we're at right now and where I see us going in the foreseeable future.
That's awesome. And I love that kind of two-pronged approach because, I think a lot of times people get stuck in one way or the other. And they think there's only one way to do that. What gave you some confidence, say at the latter stages of 2020, to then say, okay, this is what we project and this is what we want to do in 21?
Well, I think the biggest thing is just looking at rent collection. For us, the biggest concern was what happens if residents stop paying. I mean,
Mm,
this business is pretty simple and straightforward, right? We offer a product, which is housing. For that housing product, people pay rent, and we collect, the rent that comes in. You subtract the expenses, and what's left over is the cash flow. Well, if people stop paying rent, well, we're going to be upside down, or we're not going to have enough money to cover all of our expenses and cover the debt service. So we're really concerned with rent collection for a few months there. So if you go back to, I think, April and May, we really paid very close attention to rent collection. And then June was supposed to be the month, right? That was going to be the month that it fell off the cliff. So we waited for June 2020, and June 2020 was okay. And then July was okay. So by at that point, we felt more and more confident. I think as we got to the latter part of the summer, early fall, we felt that, you know, we could operate with confidence that people who could pay rent were going to pay rent. Now, I will tell you one strategic change we made. In the past, we kind of focused on anything from B plus to C minus, and we felt pretty comfortable with those types of properties and types of locations. And just to explain what I mean there, when I say B plus, I'm talking, 1980s, 1990s property, right? Maybe even early 2000s property, solid location where the household income might be in the 70,000 to $85,000 range, something like that, right? Very
right.
desirable, a place where people want to live. They if they can't buy there, they're happy to rent there, but solid schools, just a very desirable place. Okay. So that was kind of the top end. And on the lower end, maybe more of a blue collar, a little rough around the edges neighborhood, median income in the 35, $45,000 range. Just workforce housing, just not exactly desirable, but you know, um, a place where people felt comfortable, not war zones. We're not talking that, but a place where, not exactly where you would put on your top 10 places to live, but you got to live somewhere, right?
Right.
So that was on the list. And what happened coming out of, the pandemic, one of the shifts we've made is we decided to play really in that B class area. So B minus up to B plus. And our rationale is this: from a resident based standpoint, the people who suffer the most when we have these economic shifts are on the lower economic side of the scale. And we just don't think it's right to, hammer that person and try to jack up rents $50. $50 may not seem like a lot to a lot of people, but I'll tell you, when I was a kid, I didn't have $10 to go on field trips. I mean, it was $10 was a lot of money. $5 was a lot of money.
Yes, sir.
So I understand what increasing rent $50 means to a family, right? And for us to do that just for our returns, and I'm not trying to be altruistic or anything like that. I'm just saying that I think it's tough to operate a business where you're squeezing people and they really can't afford it. So I think that the margins get really tight. There's a human element that goes into it. And it's just a little harder because a lot of these people are losing their jobs. If you're working in, service industry and you just can't operate, if there's another shutdown that takes place, will these people actually have the money to go work? So there's just a lot of, uncertainty there. So I think that for us, that kind of turned us off to the lower side of the market. And the other thing is just cap rates just continue to compress.
Right.
So if you think about how you create value and you think about the way cap rates work, if I'm able to create $10,000 worth of value, right, increasing the net operating income by $10,000, well, if I do that on a higher class property, a property where there's a lower cap rate, well, that's going to create more value than a property that's on the lower end of the spectrum where the cap rate's a little bit higher. So we also have to look at how much do I want to be rewarded for the effort and the work that I'm putting in. And I think you are seeing more and more people decide to shift up and say, hey, let's buy a better quality product for that reason. And then also, let's say the market does take a change. And if it does take a big shift, I'd rather own a newer property that doesn't need as much capex, doesn't need as much maintenance, doesn't need me to go in and redo all the plumbing. I'd rather own a property like that if I have to hold on to it for 5, 7, 10 years than a property that was built 50, 60, 70 years ago. And, I'm constantly plugging holes or patching up things and constantly just pumping money into this thing. Right. So I think just from our standpoint, we're more comfortable playing in the B class arena where it's still affordable, it's still desirable, but we do like the properties where there's a good mixture of that cash flow and that appreciation potential.
Right. Yeah, I like that. I like that strategy and that thinking. Of course, it's kind of in line with a lot of people's thinking. How are you still able to find deals that meet that criteria?
Well, I don't think anybody's finding deals today. Ultimately, what you've got to do is you've got to go out there and create an opportunity. So I just had a mastermind class last night and we talked a lot about this, but you have to figure out what your principles are and what you're looking for to deal and figure out how do you create an opportunity. Because if you just take your spreadsheet, your analyzer, whatever it is you're using, you throw the numbers from the broker in there and you expect it to spit out a great number to buy it and you go offer that to the broker and you're going to get under contract, you're going to be sadly mistaken. You're going to spend a lot of time turning the wheels. I mean, Sam, I don't know how many deals you analyze, but I can't tell you the last time I analyzed a deal and the numbers spit out and it was, a good number the first time I underwrote it and I made that offer and got the deal. I haven't had that happen in years. So what you have to do is you've got to create, you've got to be creative. You have to figure out what problems you're solving. And one of the things we always like to talk about is really understanding that this is a relationship business. Now, you hear people say that all the time, but they don't necessarily explain what that means. So let me give you some context. There is an owner on the other side of this negotiation. That owner is looking to get something beyond just the money, right?
Mm-hmm.
Beyond just the capital, the return on their money. What else are they looking to get? And if you can understand that and build a relationship and help them understand how you can provide that for them, if you can prove yourself out, if you can build that credibility, if you can position yourself as the right buyer because you're going to close, that carries a lot of weight, both with the broker and the owner. So part of that is understand the deal structure, your offer, and how do you create a deal that's very enticing to an owner as opposed to simply throwing out LOIs with random numbers on there. So I think the key right now in this market is to understand what a seller is looking for and being able to solve that problem, but also being able to stand out and be a bit creative in how you structure your offer.
What are some creative things maybe that come to mind that you guys have done when you're reaching out to those sellers or positioning yourself in front of those sellers?
Well, I mean, I think part of it is also understanding the terms. The purchase price is the big thing everyone always focuses on. And it certainly is the most important thing. But there are other things that are just as important. You want to understand the terms. So, how long do you need to close? Are you using hard money? Are you using agency debt? Are you using all cash offer? So, I think the cash that you're using or the money you're using is an important thing. What contingencies do you have at play? Are you willing to waive those contingencies? Are you willing to shorten the time frame for those contingencies to be applied? Will you go hard money, works really well. It's very enticing for someone. And it's not that hard money is just very enticing. You have to break down the psychology of it. What you're saying is, I'm committed to buying this property and I'm so committed to buying this property, I'm willing to give some of my money up front to demonstrate that commitment. Now, hard money is one way to demonstrate a commitment to close. There may be other things that you can do to demonstrate that same commitment to close, right? So you just have to be creative and think through, how do you convey to a broker or to an owner that you're committed to buying that property, you're committed to closing on this property. That's what they're really looking for, right? The hard money is one thing, but what I really want is I want a commitment that you are serious, that you're going to do everything in your power to buy this property. That's what's going to make you stand out from the person who just made whatever offer that's out there.
Right. Yeah. I think that's those are some really good points. And the risk, of course, that's associated with going hard. I mean, if there's other ways to get around that and yet convey the same amount of commitment, why not take those creative approaches? How often do you guys actually get in front of or talk directly to the seller?
That's a great question. And I think this is going to vary based on the size deals you're doing, right? If you're doing a mom and pop, which is going to be more of that 10 to, 50, maybe 10 to 75 unit range, it might be easier to get in front of that owner, and talk to them. And if there's a broker involved, obviously you'll typically go through the broker, but you may have some conversations there. If you're doing larger apartment buildings, 75 units and up, 100 plus units and up, typically there are a couple of calls that are structured where there's almost like an interview, a buyer interview conversation where they want to know your experience, learn more about you and things like that. But there's typically not a whole lot of opportunities to get right in front of the ownership group. So what I would say is on the deals we've done recently, they've all been pretty interesting. One is a deal where the broker is actually the owner's son. So in dealing with that, it's fairly easy there. You got the father son dynamic there. So if we say something and it gets lost in translation or whatever the case may be, it's just easier for us to get on the phone together with the owner, right? So
Sure.
we've talked to that person a lot. We've had a lot of conversations with that owner.
Right.
On the other deal, the 81 unit deal, on the other hand, we probably had um I think two meetings, like face-to-face meetings. But we've had the email address, phone numbers. We probably talk to them once a month just to find out like certain things. Hey, are you handling this? They had a staff member who was working with them for probably 10 years. They wanted to know what was going to happen to him when we bought the property. So we talked about his salary and his total compensation package. So we kind of worked out some things there. So it kind of depends on the situation, but at that point, we had locked in on the terms of the acquisition. So at that point, it was more talking about what happens with our transition and what's the impact going to be for some of their staff and their personnel.
Right. Yeah, that's very interesting. What talk to us about these deals. I know before we came online here, we kind of talked briefly about some things you guys have learned this year in deal stacking and things like that. So can you shed some light on that?
Sure. So, we had two deals and we tried to pace them out a little bit. So one would be completely wrapped up before we really started the second one. And, timing just didn't work out that way. One deal got delayed, the other got pulled up a little bit. So they ended up, kind of coinciding a little bit more than I would have liked. And part of the lesson for us is understanding like, hey, when you've got multiple deals, how do you differentiate the two? How do you make sure you're not, uh, putting two out there and making people pick between which one they like? Because what you don't want to have is people who are committed to the first deal see the second deal and say, hey, never mind, I actually want to do that deal instead. And that
Right.
was my fear, was that we would lose investors for the first deal for the second deal, and here I am trying to get the first one across the finish line. So a couple lessons for us is just continue to build up the pipeline, and that's a really important thing with business. But the more prospects you have, the more people you can help, the easier it's going to be to go out there, raise capital, find deals, and do business. But it's kind of like a machine. You have to always have deals coming in, so you always have to have that deal flow. But you also have to always be, nurturing your investor relationships, talking to people, letting them know the deals that you're working on, understanding what they're looking for in an investment opportunity, and providing those opportunities when they present themselves. So for us, I think it was more of a reminder that, hey, there's a reason we do all these things. You have to let people know what you've got in the pipeline. You've got to be transparent and talk to people about, hey, we've got this deal. I think this one's a good fit based on what you've told me. This other deal won't be out for X amount of time or whatever the case may be. But making sure that you understand how you can help people. And I also think for us, a big lesson is understanding how deals can differ.
Mm.
I mean, the two deals, one was a townhome deal where it's 80 townhomes and there's a big opportunity to push rents. The other deal was a newer construction property where there's there's an opportunity to push rents for sure, but it's not going to be through renovation. It's going to be through operations and just the market. So I think that deal required a little bit more understanding of our analysis of what the market could take and where the market was headed versus the previous deal. We didn't have a whole lot of data points, but I think it was pretty transparent to see like, oh wow, like there's no way in the world these rents should be this low.
Right.
To give you a data point, 40% of the residents at that property had lived there at least 5 years. So I had never seen something like that. But
Right.
you're talking about people who haven't had their rents increased in basically 5 years. And I want to say something like 70% of the residents have been there at least 2 years. So 70 or 80%.
Wow.
So the point is like rents were low, all the residents knew the rents were low. They were not pushing them on lease renewals.
Right.
So we knew there was plenty of upside potential. And these are townhomes, you know what I mean? So we people they're desirable. The 3 bedroom, 2.5 bath townhomes. People want to
Wow.
stay there. They don't want to move. They don't want to move. Why? You're not going to find a property like this that you can rent. The alternative is to go buy a house. And we know that again in that B class area, especially if you're in the middle B, right now credit's still an issue for a lot of folks. So it's kind of hard to qualify for a house. So this is really the best alternative. So that business plan, we knew, we were extremely confident with. Most investors picked it up right away. I think with the newer property, because this is also a transition for us into buying newer properties,
Mm.
it was a little hard for people to quickly see like, hey, are you really going to be able to generate those returns? Or are we trying to be a bit optimistic here? So, I think for us, it's great to see the spectrum and understanding the risk tolerance people have. I will say that we are growing more risk averse right now. So I'm looking at the labor shortage. I'm looking at the cost of materials going up, and I'm less enthusiastic about deals where I got to spend $7,000-8,000 a unit to increase the value. I'd much rather find a deal where it's a light to medium value add play as opposed to a heavy lift type deal.
Yeah, and that's that man. That and those are some golden nuggets there because you're absolutely right. Material and labor shortages. I mean, you get into a heavy lift right now, and I mean, you could be waiting a long time, waiting a long time. I know we're placing a large order on some construction materials here, and it's they're like, well, January, February. I'm like, okay, all right, which we kind of budgeted in, but still, it's like we knew this was coming, but it's like, my gosh, this is a long way out. So, man, that's fantastic. So, from what I'm hearing, so from deal A, the 80 some odd units, clearly the upside and the business plan was understandable by your investors. Deal B, maybe not as much. But maybe were you guys buying more of an in-place cash flow on that deal to where it still makes money from day one, but just the value add component was missing?
Yeah, it's still a value add. It's just a light value add, right? So uh, it's more of an operation play.
Okay.
So you look at it, and again, the thing I like about these B class properties is when you look at, let's say, debt to income ratios, when you look at that and you understand what people are making in a market, and let's say the median income is $50,000 or $60,000. Well, we can reverse engineer how much we believe is affordable for rent, right? Because typically you don't want people to exceed three times, or yeah, the rent to exceed three times their monthly income, right? So if they're meaning that if rent's $1,000, they need to be making at least $3,000 a month in income. So if you're looking at that and you're trying to stay underneath that bar, that's for the rent. If you have a nice gap, maybe it's four times, right? If their income is $4,000, now it's more in that affordable space where they can maybe indulge in other things, maybe other features. Maybe they want to pay for in-unit washer and dryers, or maybe they want to pay for other features. So there's other ways now to increase your income and increase your bottom line without making it a flat expense across all people. And those are the kind of things that really make it a unique opportunity. And by buying a newer property, B class, B plus type property, these people actually have the means to cherry pick the solutions that are best for them, and that's the thing we like, is just really making it more tailored to the community as opposed to having to drive up rents by $50 because that's the only way we're going to deliver on these returns.
How do you underwrite those, or how do you make a good estimation on what percentage of the people in those facilities will take advantage of the, additional income streams you guys are, I guess not income stream, but additional services you guys are providing for them? How do you build that into your model?
Well, it's so important to have great teams. If you're going to be a real estate investor, we talked about this being a team sport, you have to rely on your teams and the knowledge that they have. So in this case, you want to understand with your property managers, if they have a large, number of units that they manage, it's great to lean into them. Hey, if you got a 5,000 unit portfolio, what are you seeing across other
Mm,
properties that offer these amenities? What's the adoption rate? Is it 20%? Is it 30%? Is it 40%? And what's the range? So you can at least go in there and you can make some good educated guesses. You certainly don't want to be aggressive in your estimations. So you want to certainly be conservative. So if the average is 30% adoption, and let's just cherry pick something to say, let's just say pet fees, right?
right.
If on average 25% of the residents are willing or will take a pet and pay pet fees, maybe you only underwrite to 20%.
Hmm.
Right. So maybe that's what you do. You give yourself a little bit of buffer there and say, hey, if we get 20% by the end of the stabilization period, then we'll be in a good place. So that's kind of how we play it. What I will tell you though is this. I think it's much less about the operator and how we underwrite. Certainly you want to understand those things,
Sure.
but I think it really comes down to the investor. And you have to understand what your risk tolerance is. What are you looking to do? Where are you at in your life? What are you hoping to get out of this investment? If this is meant to be a home run investment, some of these deals are probably going to be too conservative for you. If you're looking to triple your money on a deal, this kind of stuff is way too conservative, right? You probably want a ground up construction or something that's completely distressed that you can go in and just, gut rehab, right? So you can make that huge return. Where we see the market right now being a bit in flux, not knowing when a recession may truly kick in, looking at interest rates potentially going up, our play is this is more defense
Mm,
that leads to offense. So we want to buy properties where, they don't need a ton of work. We want to be able to create value still. We don't want to just buy something and hold it, but we want to create value still. But we don't want to spend $10,000 a unit creating that value. So for us, this is an opportunity for the investor who's looking to park capital, make a solid return, still take advantage of all the amazing perks that real estate and particularly commercial real estate have to offer, but not necessarily take on the additional risk of the renovation. There's a contractor shortage. There's a shortage of labor in general. We talked about materials. Supply chains have been completely disrupted. So when you look at all those different aspects, for us, we said this deal is for that investor.
right.
That doesn't mean that you can't do a deal that's ground up or anything like that. That just means it's for a different type of investor. The investor who's at a different stage, and maybe you've got a portfolio and you balance it. Just like if you invest in stocks, right? You have maybe your emerging stocks, your emerging portfolio stuff. You've got your value stuff, right? So it's a similar mentality, and I think this property was one that was still cash flow in day one, still has that value add potential, but doesn't have as much upside as maybe some other deals where there's more renovation going on, but it doesn't have it has a higher floor than I think a lot of those other projects do.
Right, right, and risk and reward certainly go hand in hand there as well. So I love your thought process behind that. Love what you guys are doing, John. This is awesome. Thanks for giving kind of the recap of the last 12 months for you guys. Your thinking behind the end of 2020 and what you guys have done here in 2021, and sharing kind of the lessons that you guys have learned. Certainly have enjoyed once again having you on the show. Last and final question for you. If our listeners want to get in touch with you, learn more about you and the Casmon Capital Group, what is the best way to do that?
Well, we've got a sample deal on our website, so you can check that out. That's the easiest thing for you to kind of get into our email database, get some information about the way we think about deals, and learn more, whether it be a deal we're doing or someone else, quite frankly, learn what to look for. When
Mm,
you're looking at these opportunities, try to get a sense of again, the conversation we had, how do you break down, the thought process of what's going on and how this deal has been underwritten, and, what should you be paying attention to? So you could check out that sample deal at casmoncapital.com/sample deal. And we're going to get you on our show as well, Sam. So you can check out our podcast, Target Market Insights, the multifamily and marketing show. But either one of those two things are a great way to get in touch with us.
Awesome. John, thanks again. Do appreciate it.
Thanks, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.